Thanks, Nama. I appreciate you having me on the call on the seminar, and I think it's a very topical topic for Toronto, and I'm sure for many other cities in the world. My name is Donny Afonso. I'm a principal at Pelican, Woodcliff. I'm a quantity surveyor and cost consultant that's been in the industry for 24 years. Pelican Woodcliff is a Toronto, Richmond Hill based consultancy that focuses in on the construction costs and the development costs for our developer and lender clients. So I'm going to give you a short presentation in which I feel is a very complex part of your investment decision, finding your site and testing the feasibility. So I should start off by explaining that my perspective, I can only give you from what my specialty is. I can only give you how, from my perspective of working with our lender clients and our developer clients and how they assess feasibility, specifically focusing in on the construction costs and on the development costs of the projects. So to start off, what I'd like to do is just have a little bit of terminology definitions. So I know many of you may have a good understanding of all the definitions that I'm going to have on this chart, but I thought it'd be a good, even the table, get everybody started on the same terminology. So construction costs are often called hard costs. So that includes your demolition. So what do you have to demolish in the existing building or buildings? Site servicing, do you have to provide services from the existing servicing that's in the city, the storm, the sanitary, the gas? And then the building costs, your actual hard construction costs that you're going to build for your asset. Soft costs, so your development costs. These include the costs for your consultants, for your approvals, so what is going to be, what needs to be paid to the city to make the project happen, for administration, for sales and leasing, so how much do you actually have to pay over to brokers for selling and leasing the project, and then financing. Buildable gross floor area. I thought it'd be very important to define this because it's often confused with zoning GFA. So buildable GFA is actually what you build. Zoning GFA, what Nama mentioned as an intro, a lot of planners and architects use the zoning GFA. That actually excludes a lot of areas, or can exclude a lot of areas. So we focus in on the buildable gross floor area as quantity surveyors. So it's very important that when I speak about GFA, I'm talking about the buildable. And then the above grade buildable GFA, a very important metric when people do performers is how much of the buildable area is above grade, and that excludes any of your basement costs and any of your below grade area costs. And then site specific costs. So costs that are unique to your site, including the unique cost savings that would come with you developing your site, or the cost premiums. Cost premiums being things that are driven up, the costs being driven up by certain premium items. So we'll go into a little bit more detail in this item, but I think it's a very key item for us to define. It's site-specific costs. So a couple of technical due diligence items to go through in the next couple of slides. Finding your site and testing your feasibility, I'd say one of the first things to do is have a pre-agreed objective, financial objective. You're going to have partners that are going to be giving you equity, giving you loans, your lending partners. Everybody's going to have different requirements. It's not that you're going to have equity partners and lenders partners all fully aligned. You have to know what their requirements are and plan for it. Concepts for your project, massing diagrams and site plan with statistics we always see as the first step for actually assessing options. But at an early stage, still your buildable GFA and your sellable, leasable areas are the basis of your costs. So if you've got your square footages wrong on your cost side or on your revenue side, at an early stage, you can quite quickly assess your project wrong. Due diligence, that being the zoning, the approvals, the soils, the building conditions. For renovation projects, you often do a building conditions reports. Actually, we would insist on it, but that would be your due diligence that you would do. And then you'd focus in on the site-specific costs. So your due diligence would really focus in on what makes your site unique, where can you save costs, and where would you have cost drivers. So where are the cost premiums on your design? on your unique area, on your unique site. Parking solution. I think it's one of the most key things that I would say to anybody assessing whether the site's going to work or not is knowing the parking requirements, drawing it, and also realizing that increased density doesn't always increase. It doesn't always give you better returns. In some cases, depending how your parking gets drawn, you may actually lower your returns. So your return on investment, ROI, profits over total cost, your percentage may actually drop quite significantly depending on how much parking you have to do and what the parking solution is. So pre-agreeing the financial objectives, aligning the project risk appetite. So not everybody's going to be open to high risk. Are you open to high risk? Is your equity partners all open to high risk? And if you mitigate in a certain way, your lenders will be fine, or your lender's not open to certain high risks at all. So just know the appetites for risk that each of your partners have and align them. Timelines. Is your money that's coming in, the investments that are coming in, whether it be loan or equity, has it got time restraints? So construction loans always have time restraints. They always have you need to pay by a certain date. Generational equity investments, where you're actually investing because you're going to hold the property for generations afterwards. You don't necessarily need that equity back. So you're gonna have an investment that's going to be over a 20-year horizon over a 2-year versus a 2-year horizon for a land loan or a construction loan of 3 years. Equity constraints. Are you going to leverage the project? Are you going to be able to use construction loan, or are you intending to just fully use equity? And your expected returns, your ROIs. Most developers we see use ROI as a way of gauging the success of the project. That would be the profit over the total cost. But in some cases, it's more about what income's been generated. So what's your net operating income from a leasable building, leasable commercial, leasable residential project? What net operating income can you expect on an annual basis? And that as a percentage of your investment is how you would rate your returns. Land stage partners and construction stage partners. I thought it important to just speak to that. Could very simply put, during land stage, you have partners, and during construction stage, you have partners, and those equity or construction partners may get paid out at certain points. If you have a takeout at a certain point, in other words, you've got a changeover from partners, equity needs to be paid back, or loan needs to be paid back. The question of whether you can actually lift the land value now that you've got your approvals in place and you're about to start construction, that would be the question. So would you be allowed to lift? Some construction lenders will not allow for lift in land, but if you've held the land for 10 years, you've assembled over 10 years, and now you've got your final approvals and you've got an approved design, maybe your construction lenders will allow, but know if you're going to be changing partners and if the land lift will be allowed. And lenders needing experience. It's very important, especially as you embark on more units. I think the 1 to 2 unit projects, the missing middle does include some smaller projects, in which case you may have a lender that's fine with you not having the experience, not having completed your own assets before, or partnering with construction contractors and CMs, construction managers that have the experience. But as soon as you get into the 3, 4, 5 units and plus and more, you would be needing an experienced partner. So you would actually have to be hiring a third-party construction contractor or getting a construction manager to get you third-party trades. But it all comes down to experience for the lenders. So when it comes to concepts for your project solution, we feel that it's very important that you mass diagram and provide site plan with statistics for all your options. Consider all your options. Are you going to be building up? Are you going to be renovating back? Are you going to be doing below grade? Everything that you're going to have as options. And for each of those options, be clear on your construction areas and on your saleable areas. it's not always that your sellable and buildable areas are the same. So know your efficiency of your design. Efficiency of design is the saleable or leasable area as a percentage of your buildable GFA. So if you have a saleable and leasable area of X, it doesn't always, you don't always get X, you don't always have to build X to get the saleable leasable area, and maybe X plus 15%. So your efficiency of design is actually the other way, where your sellable, leasable as a percentage of the buildable could be as much as 85% in condos, as an example. So mid-rise condos and walkable apartments, you would actually end up at a far less efficiency and be able to sell or lease far less of the building than your buildable area. In most low-rise asset classes, you actually have everything you build, you sell, but not always the case. Stacked townhouses, we've had some stacked townhouse projects where the design just, for whatever reason, they had to build a little lobby at the bottom of each of the blocks, and that lobby you couldn't sell or lease to each of the units, so you ended up losing some space. You couldn't sell everything that you built. So just, it's important to know efficiency of design is a very key metric when you're testing your feasibility. And then the iterative design. So don't underestimate how important it is to iterate, to do the design, revisit the design every time that you eliminate options, and as you get more feedback from various parties. So you could be getting feedback from the city on what the requirements are, on the look of the building. You could be getting feedback from your sales and marketing team on what people are expecting when they move in. So by the time you get to tender ready drawings, what we call contract set of drawings, your cost certainty is a lot more accurate at that point. You actually have a design that actually is going to happen, versus just massing and you're thinking of something that you're going to do right at the initial stage when you're just buying the land. So due diligence. When you're doing your due diligence, know what's happening on the zoning and approvals, know and plan for it. Each of those options that you have for your design solutions will include timelines. Are you going to be staying within the limits that you have, or are you going to be pushing the envelope and increasing density? The timelines can be pretty significant in those two scenarios I just painted. And the costs as well. So you would actually have some extra costs that you have to spend to get that approval through. So know the timelines and the approvals for each of your zoning and approvals options. Soils. Make sure you do your homework on your soils. Your due diligence on the foundations, whether you're going to have simple foundations. Do you have any high water table concerns? Do you have any dewatering concerns, like while you're constructing, or even permanent dewatering? So can you build a basement? Because if you do a basement, do you need a certain approach because you've got very high water tables? And environmentally, are your soils clean? Or do you need some remediation? Building conditions report, very thorough is what I would recommend when it comes to these reports. I can't insist on it enough. We've seen too many renovation projects that go ahead with a very light building conditions report, and then when it comes to during construction, there's all sorts of surprises. Specific questions that you need to be answering in the building conditions report is, can the existing structure, envelope, windows, floor heights actually be suitable for the converted use? So we've got one project where they're converting from schools to residential. The reality is floor heights may not be right, so they've got a whole lot of work to do on the floor heights. We had one project where it was from a church to residentials, and there the window structure wasn't enough, and the building conditions report missed it when we first started the project. There was a building conditions report, but that missed that the windows wouldn't work for this one project. Site-specific costs. So do your homework on the costs that are unique to your site. So know if there's any unique city requirements. So you have to do a road widening. You have to do an intersection of the project. Are there specific setbacks on your project that will, as soon as you tear down your existing structure, are there certain setbacks that now apply? And are there some design requirements to your project you have to have a facade that looks precast and looks older world versus no design requirements by you. Limited space. Noise is limited space, not only for during construction, so it's the access of the trades to get onto construction and actually construct, but also where the materials are going to be laid down. So if you have a project that's being built to property line, you really do have to think about where your materials are going to be laid down as you load into the building. Do you have to actually have a road closure or partial lane closure? That costs money. And increases timelines. Is your project too small or too complicated to get contractor pricing? Everybody's been reading in the news. It's not a big surprise that the trades are at capacity. Contractors and trades are at capacity in the market, and that's for all asset classes. So whether you're talking about the skyrise 40-story plus, or you're talking about a missing middle project, you really do have a struggle to get contractors. So if your project's too complicated, if you've gone with a design that's just way too complicated, an example, a renovation, that may just not get any pricing. You may go to the market and nobody's going to be bidding, or maybe too small. So maybe you've just gone for 2 units, and really to get trades interested, maybe you need a third unit or something like that. So just know if you're going to have to add extra pricing, because when you don't get all the trades coming in, you actually really need to allow some extra pricing on the costs that you're going to get from the tenders. A tight floor plate and an unusual approach to the structure can also add to your project. So if you have a project where you have a very tight floor plate and you're trying to get units in on a walk-up apartment, you may end up having a very unique approach to the corridors, in which case your design efficiency gets affected. In other words, you're not building, you have to build a lot more than what you're actually going to get to sell or lease. And you also may have an unusual approach to the structure. So you have 3 floors in total, 2 floors of concrete, and the last floor is timber. That's an unusual approach. So you may end up having some premiums coming from the trades, because they want to do things that they're familiar with, and as soon as it's something that's unusual, they'll add a premium to the pricing that they give you. So for their tenders, they'll come in with extra pricing. Unique building features. Terraces, everybody loves terraces, and when you go down to the beaches area, you've got all these terrace condos and things, walk-up apartments that actually try to provide a terrace. Just know that terrace comes with a price premium. So that actually does add cost to your project. You may work out that it's going to add an extra revenue. So in other words, you're selling for more or you're leasing for more because you have the terrace, but know that there's an extra cost to that. And also projections. So the envelope, if it's really funky and looks all pretty, it'll come with a price tag. And maybe that's what you need to get your revenues up, but just know that the price tag is there, and you really do need to price it into your project. And parking solutions. Again, key is draw it. If you need to provide parking, draw it. Know what your city needs. Know what you need to lease or sell. There's some units you won't be able to sell or lease if you don't have a parking, so you really need to build at least one for each of the units. In some cases, maybe even 2. But know what parking you need to provide, and the key is knowing and planning for that parking ahead. Because you don't typically make money on parking. So if you know how much parking you need, and you build just what you need, you won't hurt your profits. Yeah. So a couple of slides on some metrics. These are the cost breakdowns for construction projects. So what we did is we went into our database of projects and then pulled out as a trade division on the left here. I think you can see my cursor. The trade divisions for wood and plastic, as an example, with the percentage of the construction costs that becomes. So wood and plastic, typically we'd see that at about the 17%. Finishes also at about the 17%. So between those 2 trades alone, if you add mechanical and electrical, you're almost at half of your project costs, in those trades. And then concrete and site works. Some concrete is higher because you're actually building basements or an underground. But when it comes to the site works, that could be if you're doing site servicing or not. But I would really generally focus developers in on know your wood and plastic numbers, know your finishes numbers, know your mechanical, electrical numbers, then you start to get a really good flavor of where your costs are going to go on your project. So this slide is actually a cost per square foot range that we want to present. It's taken from historical project costs that we escalated to quarter 4 2021, and current costs that are contracted. So in our project database, we've got projects that tell us that the asset types, so walk-ups, walk-up apartments, single detached, stacks, and infills would be low end of the cost. The construction costs would be anything from 140 to 180, with 180 to 260 being the high end of the costs. It's very important when you use these cost charts to know that it's only indicative. You cannot use these for every project. You really do need to make sense of what are your site-specific costs, what are your site-specific premiums and savings. And also for you to realize that this is mid-level. So if you wanted to go high level, you clearly are going to have to add premiums onto this for high-level finishes and the like. But between 160 and 220 is the average construction cost that we would see as a cost of the above grade costs. This doesn't include basement and below grade costs. Something also to realize that if you wanted to service the lots, that's on top of, so between 30 and 60K per lot. And then if you add in a below grade, that would include the services. There's a basement that you build in, an underground parking, between 130 and 160 for that below grade area. So on top of these costs, you would add those to get to your total construction costs. When it comes to the soft costs, we see that as between 45% and 70% of these construction costs, depending on what assets, apartments and stacks have higher costs, soft costs, just because they're more complicated and more timelines, so they've got more financing costs. But the idea is between 63 and 90 for your low end, 108 and 182 for your high end, which averages out to about 85 to 136 bucks a square foot for your soft costs. Again, on a above grade buildable GFA. The important thing in this chart is also to tell you about escalation. So construction costs historically increase every year by 2 to 4%. But in the last few years, or at least a couple of years, it's been at least 18 months, where construction costs have just been going unbelievably, growing at an unbelievable rate. So they're especially commodities driven, but also supply chain driven. So commodities, lumber would be a big hit for the low rise space. Lumber went up quite significantly. Commodities dropped with the sales, but the trades are still not showing the savings. So we're actually predicting that there's no end to the above average cost escalation rates. Between 8 to 12% is what we would estimate for the next 12 months. So that is my slide. Thank you. I think the way Nama did this is that we have time for some questions and answers.
Yes, correct. And there are a few already in the chat box. First of all, I know the answer. We can answer it together. But there's a question of the difference between buildable, GFA, and GCA. And I will add another 3 letters of NSA. So maybe you could, again, I'm happy to do that as well. But if you want, from your perspective, cover the difference for the audience.
Very good. So gross construction area is buildable GFA. So we just use buildable GFA, but a lot of people in the market use gross construction area. Net saleable area or net leasable area is NSA or NLA. So those are the areas that you're actually going to be able to lease, or you're going to be able to sell on your project.
And Yaniv, I will just give you my clue. So GSA will include underground parking or anything that is underground, and GFA is the box. Imagine the building box that you see, which includes, for example, above grade loading and retail, And then when it comes to NSA, okay, then you deduct corridors and elevators. So this is how I think of it. But it's a very good question. And I have very experienced clients ask me, can you help me understand GCA versus GFA most of the time? NSA, they know. So I was waiting for someone to ask that question, Donny, and feel free or whatever you feel comfortable answering. And that is, what is the cost per square foot today? Or how do you even, let me rephrase the question of, how do you even tackle that? Because I get that question a lot, and I say, it's not with I don't even, for reliability purposes, I don't want to answer that. But how do you answer that question before you issue a report?
Well, first off, if we're answering it over the phone, we're very, very careful to give ranges, because like on this chart that I'm on, that I stopped my presentation on, there's a very big swing in construction costs depending on which asset class you're going on. So I would say the key is drawing it. And once you've got it drawn, it doesn't have to be all detailed. It could actually be a site plan with statistics. But once you've got that, then you can take it from there. But I think generally there's a norm where people would be thinking when they approach a project and a solution. But typically we would see it as a big range, and then you start to refine as you get more information about the design. But the construction costs for low-rise is volatile right now. Construction cost increases are very significant. And it's not the norm. So people that are out there that are trying to make sense of construction costs, I totally get that they're trying to make sense of all this. It's a confusing times.
Okay. They're asking about, if these numbers include servicing.
Oh, yeah. So on that chart that I had, maybe what I'll do is I'll just resume the share quickly for a second. You can see down on the bottom that servicing is an extra on top of. So allow 30 to 60 per lot. 60K per lot. I mean, clearly, if you have a civil engineer that's actually estimated what your site servicing is going to be, that's more accurate. But when you're at a really initial stage, you haven't actually got any estimates done. An allowance 30 to 60K would be
working. The cost difference between extended or projected balconies versus inset balconies. That's a very interesting question, actually. Is that a major difference that you see or take under consideration, Donny?
It would affect things, but it's such a small adjust. I don't have specifics I can answer there. So I mean I totally see how if you have projected balconies and inset balconies, I mean, I question why you would do inset balconies, because you'd probably sacrifice in sellable or leasable area to do that. Why would you? Wouldn't you just build to the property line? But my guess is maybe you are building to the property line, so you can't have the projected.
Yeah, if you want to have a window, for example, facing that, you can't build up to the property line.
Yeah, but I would think a lot of people would just do Juliet balcony in that case, so they wouldn't sacrifice sellable.
So from your analysis, it doesn't make. How do you treat? Okay, no.
Well, no, I think if we're doing a 16 division cost estimate, like we would actually cost up the components, and buildable, extending definitely would add cost. In would actually save cost, but you'd lose buildable area, right? So anyway, I think it's an analysis that I think is probably bigger than just the construction costs, is what I'm saying.
What is the main driver of decreased efficiency in the design of small residential buildings? Is it basically corridors and lobbies? So I think I will answer that as the architect. The main difference is first of all, just imagine from code requirements, each building must have 2 staircases, for example. So it's the same net area that is deducted, and then the question is how much meat you have on the rest of the building, and that really decreases the percentage, because when you're talking about efficiency, we are talking in percentages. So just a very wide range without being accountable. But for missing middle, we even saw as low as 76. For example, when we talk about mid-rise buildings, it's usually 83 or more. Again, this is very generally speaking, but just to give you an idea that it decreases. So you can, in missing middle, around, we see around 80 percent of efficiency. Donny, maybe one last question. Sorry.
Yeah, that's a good target. And I do see our developers try focus in on that 80, 85 if they're being aggressive. But unless you've got it drawn by somebody like Nama, you really don't know if you're going to be closer to the 76 or you're going to be closer to the 85.
Correct. Two last questions, Donny, and we have Adam is already here. Hi, Donny, what is the range of direct cost for a mid-rise, mid-level condo on an avenue? Timeline for construction. Can you answer that very quickly?
Yeah, so very quickly, condos used to be in the 250s. I would say now that the blended rate, and that's assuming 30% is below grade and 70% is above grade. I would assume that you're now in the 3.25, 3.5, so 325 to 350 kind of range as a blended, and that you apply to the above grade square footage to get the total cost for the construction of below grade and above grade. So you're very significantly higher than the costs that we have up here, right? Which we've got between 160 and 220 as an average. It's definitely a different animal.
And the last question, I really like this question. What role can prefabricated or modular play in helping to bring cost efficiencies for missing middle? That's a good question.
Well,
missing middle, too early?
Yeah, my understanding of missing middle is more of the infill projects. I think with just my experience and my opinion, and please just take it as one opinion in many specialists, I'm sure. But from a cost perspective, I don't see efficiencies in precast solutions until you get into bigger volumes. So maybe the walk-up apartments, that's where you can get, especially if you have a certain product that you're just going to cookie cutter filter throughout a neighborhood. That there may end up being 10 projects, but you're using the same design solution. Prefabricated could definitely make sense, and where it actually makes more sense from a cost perspective is the savings in time. So generally, you would actually have things up quicker, and you get out of there quicker, and you get your equity back quicker, and the loan gets paid back quicker. So that I think those are the main reasons why people would go prefabricated.
Donny, thank you very, very much. By the way, there are lots of unanswered questions, and it just speaks to how good your session was and interesting. So thank you very much. Adam is already here, so we are switching to our next topic. Thank you again, Donny, for being here with us. That was fantastic.
Thank you, guys. Thank you. Appreciate it, Nama.
Bye, Donny.
Okay, thank you. Bye.